Today I'm going to cover Mike Wilson. Many of you follow Mike Wilson, the Chief Investment Officer at Morgan Stanley, Chief U.S. Equity Strategist at Morgan Stanley, and he predicted a decline in stocks last year, and that didn't happen, it appears. What I'm going to do is show him, and he is going to admit where he messed up last year, but he is going to defend where he got it right last year. I think you'd find this interesting. Then I'm going to cover other views of the market for 2024, both positive and negative. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is January 9, 2024. I'm broadcasting this from my home in Big Fork, Montana. This is the northwest part of Montana, the Flathead Valley. And it is known in Montana as kind of the most moderate part of Montana. Sometimes people affectionately call it the banana belt of Montana, if there is such a thing. In the summer, it's more moderate. In the winter, it's also more moderate. It's hard to say it's warmer, but it's less cold in the winter. Today, January 9th, it is 24 degrees out right now. It's been, some snow. But there's predicted to be a lot more snow, and by Saturday, I'm recording this on Monday, so on Saturday, it is predicted to be minus 27. I've been here 7 years. The coldest it's been, which has been 2 or 3 times, it's been down around minus 20. I've not yet seen minus 27. But I may get to see that on Saturday. So it will be chilly. It's minus 20 is chilly. And, but if you were to go for the coldest part of Montana, you can look it up on Saturday. Usually the coldest part is Cutbank or Havre. Those are the 2 coldest parts, or maybe someplace in North Dakota becomes the coldest part. But those are usually the coldest parts of the U.S. during the winter. Okay, enough about the weather. This week I'm going to cover 2 or 3 things. One, Mike Wilson, Chief U.S. Equity Strategist for Morgan Stanley and Chief Investment Officer. And last year, he predicted that stocks were going to come back. The S&P was going to come back down. And partly he got it right, and partly he got it wrong. He admits to both. And he's going to cover that. On the stock piece, most stocks he was right on. However, the indexes he was not right on. So he covers that. And he gives his prediction for this year, which is bearish during the first half of the year. That's his prediction. So I'll cover that. Also, I'm going to cover the estimates for this coming year from a number of people. There's still a lot of people who are on the other side of Mike Wilson who are optimistic, bullish, and they give their reasons for that, and they're valid reasons. So I kind of tend to agree with Mike Wilson more, and he is more, he's more on the realistic side, I think. So I'll begin with Mike Wilson. I think this will be a good place to begin, and I do agree with him because I think the market is probably going to have a pullback. It's kind of overbought right now. Going to have a pullback, he says, during the first half of the year, and then he expects it to be positive during the second half of the year. Keep in mind, this is a presidential election year, and it's also a year for Olympics. As a result, what happens during those years is a lot of advertising, which drives up revenue, which drives up, of course, that drives stock price. So anyway, I'm going to play this piece from Mike Wilson. I think it's instructive. You don't have to agree with it, but if you're looking for kind of a balanced approach that the market's got some downside and has some upside, it may make some sense to you. So take a listen.
Mike, what makes you, yet again, bearish on a year when everyone else is finding a lot to be bullish about?
Well, look, I think it's really more about the stock picking, which is really what this year's been about too. The average stock has not done particularly well. It's kind of been a strange year in that regard. Our earnings forecast for the average stock has turned out to be, dead right, and same thing for the average stock. And then we've had these, 10 or 20 or 30 stocks which have done extremely well, and they've done an incredible job of cost cutting in particular, which has driven the major average, the S&P 500 earnings up in a way that we did not project. And that has been the difference. And we think that that dynamic will probably persist next year, at least for the first 2 quarters, meaning smaller, lower quality businesses are going to continue to struggle. And then maybe by the second half of next year, when we see actually inflation bottom, ironically, that's when the earnings will come back. And I think that's been the trick. I mean, if you think about this year, inflation's been coming down, which usually is unequivocally good for bond yields. It's also good for disinflationary assets. It's not good for inflationary assets, which are basically small cap stocks and generally average stocks. The average stock does better when inflation is actually accelerating. And I think that's been the trick this year. And most people got it wrong, quite frankly, because there were many people recommending, small cap stocks and financials and cyclical stocks, and this just don't work when inflation's coming down.
Mike, what you outlined, though, raises a question about the 4,500 target on the S&P at the end of next year. Is that assuming the big tech can't keep leading, that essentially there might be a recovery of some of the other stocks, the smaller caps, but that there will be at least some stasis for the big tech names that account for the lion's share of a lot of indexes?
Well, that's right. I mean, basically, this year has been all about multiple expansion, and this is in a year also when rates have gone up for most of the year until recently. So that's a combination that is unusual, as you know. So, our call at the beginning of this year was that rates were going to rates had normalized, quite frankly. They were going to continue to normalize, and then therefore multiples should normalize. So the real difference between our price target this year and what's transpired has been all multiple. We thought the market would close the year at 17 times earnings, which seems to be a fair multiple in an environment with 10-year yields north of 4% and some sort of level of risk premium. But instead, multiples are 19 and a half times. So all we're saying, Lisa, is that multiples will adjust this year. Earnings will be fine still for those large cap companies, but the multiple offset probably has them churning in place. And there will be some, obviously, that can continue to deliver better earnings growth, but it won't be all of them. It won't be as broad because that cost-cutting story isn't going to be as easy given the tougher comparisons on that front in 2024.
So I'm going to give you 3 pieces, 3 clips that are optimistic. So if you're an optimist, you think the market's going up, you want it to go up, and you're looking for rationale for that, I think you'll resonate with these 3 pieces. The first one is Eamon Javers from CNBC interviews Ryan Dietrich from Carson Group and Nancy Tingler from Laffer Tingler Investments. And they make the case, the reasons why they believe the market is going higher. Nobody is saying it's going to be 20% or more. They're not saying that. Most are saying it'll be positive and maybe 10%. I've heard 10% a couple of times. So not a big year, but a positive year. So take a listen to Ryan Dietrich and Nancy Tingler.
It is a rocky start to 2024. So can the bulls shake off the New Year blues, or are investors set for more pain ahead? Well, let's talk about that with our leadoff panel. Carson Group Chief Market Strategist Ryan Dietrich and Laffer Tingler Investment CEO and CIO Nancy Tingler. Thank you guys both for joining Last Call tonight. Ryan, let's start with you. Explain to me how last month's Santa Claus rally turned into this New Year's hangover we're dealing with this week.
Yeah, I guess stocks can go down, right? Like you just talked about 9 weeks. Yeah, I guess so. Who knew? A 9-week win streak is over. I took a look at that. What does that mean, right? Like you said, longest is 2004. 1 month later, the S&P's been higher 8 out of 9 times after that 9-week win streak. Okay, so just think about that. Then also, when you have a 9-week win streak, a year later, the median returns of over 12% on average. So there's just some context around this. But listen, The bottom line is this. We know we had a huge rally to end the year. Yes, we did. We got a little coal from Santa because the Santa Claus rally didn't take place. We've seen some bear markets historically when that doesn't happen. I think simply it's a market really catching its breath. You mentioned, obviously, tech and Apple getting the downgrades. Yes, that's pulling back a little bit, but we're still overall encouraged. This big theme next year, my final comment here, is just the broadening out, right? Small caps and mid caps, there's no recession likely coming, in our opinion. The Fed is done. We know all these things, but we think it's just as this bull market ages, we're going to get more participation than just 7 stocks. Like, we never believed that last year, to be honest, but we heard that a lot. And we think there's going to be a lot more stocks participating before this year is all said and done.
Nancy, what's your take? Is this just profit taking and breath taking here, or is there some teeth gritting and looking ahead at maybe a tougher year than we thought?
Amy, good to be on with you, and Ryan, thanks so much for having me. I think you have to kind of step back and say, what is, where are we from an economic standpoint? And I think all the alignment, and we've written about this extensively, is that this market is more analogous to the 1990s than probably any other period. We got the JOLTS numbers this week. There's a labor shortage. Historically, when there's labor shortage, companies spend on technology, productivity goes up. So even with higher average hourly earnings that we saw, I think that you want to be long this market and you don't want to give up on technology. So use the weakness to add to holdings in that group. And then, yes, of course, the market is broadening and we all own more than just technology. But I think that the death of that trade is much overdone. Mm-hmm. And we have continued to add to names in periods like this. We added in October of 2022. We added in October of this year. And I think investors want to use weakness and volatility, which is the friend of the long-term investor, to add to some of these names in here and across the spectrum. Last thing I will say is that our investing theme has been old economy companies that have pivoted to digitization, generative AI, and cloud computing, and then the suppliers of those picks and shovels. We think that theme survives for a few more years. And so look for great companies that are pivoting to the digital revolution. And I think you'll be happy that you added to those names.
The second positive piece I'm going to give you is that Kelly Evans from CNBC is interviewing Steve Auth, who is again making an optimistic case that stocks are going up. What he's focusing on are the stocks that are kind of beaten up. And the ones that have been most beaten up have been small cap and mid cap stocks. So he says those are good values, and as the market establishes more breadth, it will encompass more of the small cap, mid cap, and it'll give those an opportunity to go up. So take a listen to Steve Auth.
Stocks are on track to close the first trading week of the year with 4 consecutive down days, and that could be bad news. The Stock Traders Almanac warns the first 5 trading days aren't open for the rest of the year, but my next guest is a little more optimistic and, in fact, says he's rarely seen this many good investment opportunities. Here with me now is Steve Auth, the Chief Investment Officer of Equities at Federated Hermes. It's great to have you here. Welcome.
Likewise, Kelly.
Especially because your mood is so different from a lot of the, well, okay, maybe it's not as different right now. We've seen a lot of optimism around the turn of the year, but you're saying you really see a lot of opportunities out there, even with stocks near all-time highs.
Yeah, I mean, we're the broader market, Kelly, we're thinking 5,200 as our target for the end of the year, so it's not heroic, probably single-digit return kind of market. You know, maybe we're setting up for 10% off of current levels. But we think the excitement is underneath, because obviously most of the return in the market last year, well known, was the Magnificent Seven, and everything else didn't do much. Mm-hmm. And now there's so many stocks out there that are still 10, 20, 30, even 50% off their old highs. As we break through, if you get into an economic situation like you've been discussing that's not a big recession, we think it kind of happened already in an asynchronous way.
You think it happened already?
Yeah.
This kind of series of as we've talked with others, or Steve Leeson, about rolling recessions or mini recessions. Look at the ISM manufacturing, 15 months negative, that kind of thing.
Right. Our rocky landing idea that we were going through an asynchronous recession for the last 18 months, chips, housing, commercial real estate, the regional banks, et cetera. And I think we were going to look back and say, gee, the recession already happened. So once you get to that point, then all these stocks, these higher risk stocks, smaller cap stocks, value stocks, cyclical stocks, emerging market stocks, mm-hmm. that have been held back because the recession is about to happen. And the date of it keeps getting pushed away.
Right, and you were optimistic all of this year, and the market and the facts have come around to that point of view. So you think it's kind of, we can keep going, even where we are. And you have some names here: New Fortress Energy, it's a small cap; PNC, the regional bank; Argenx in biotech; Tencent in China. You're not afraid of emerging markets here either.
No, those are the most oversold stocks in the market. And with the dollar starting to soften up, interest rates coming off, and expectations being so low. I mean, everyone's calling China uninvestable.
Hong Kong, didn't they just have 4 down years in a row on that market?
Yeah, and that's usually a bell ringer when something's uninvestable and it's in the cover of Barron's, can't invest there. So these Tencent, as an example, is, let's call it the Facebook of China, and it's trading at a single-digit multiple. It's down 60% off its highs. All you need is just a whiff of good news, and those stocks are poised to have big moves up.
And finally, Scott Wapner interviews Stephanie Link from Hightower, and she makes the same case. Now, Stephanie Hightower, they have her on quite a bit, and she's an optimist. She always thinks the market is going up. That's what I've always heard. So you have to factor in that bias into it. But she does give the case for it of why she believes that's true for this time period. So take a listen to Scott Wapner and Stephanie Link.
Let's bring in CNBC contributor Stephanie Link of Hightower into the conversation. Steph, it's great to add you. So what's your big takeaway then from the way that this week has started and this year has started?
That the economic data is supporting the soft landing that all of us are talking about. I always worry that when we're all talking about the same thing, but you got to look at the numbers, Scott, and it's not just the job report today. I mean, look at ADP, look at Challenger Gray, look at initial claims, which is a leading indicator. That's at 207,000 4-week moving average, so far from a recession. But then I also look at durable goods, and I looked at factory orders, and those numbers came in better than expected, with business spending intentions going higher. So there are parts of the manufacturing part of the economy that are seeing a pickup because of the onshoring, the reshoring, all the infrastructure bills that have been put in place. So you kind of add it all up. The growth is there. Obviously, we all want to see the inflation numbers come down so that the Fed can cut, but it's not. It's still at 4.1%. It's still okay, but it's elevated. So that's why I don't think the Fed is going to cut 6 times this year. And if, by the way, they do, that means we have a massive decline and a turnaround to the downside in the economy. And I just don't see it at this moment in time. So the 3 takeaways: I think fewer cuts, I think better earnings, and I think the consumer has actually been really strong. And I'm really encouraged by Costco. And I know Costco is a beast in itself, but you had 100 basis point acceleration, x the 1 extra day that they had this month from the first quarter, 100 basis points acceleration. And you had a 400 basis point acceleration in non-food purchases. That's discretionary. So my thinking is maybe services is coming down a little bit from the torrid pace that we've seen, but maybe that we've seen the bottom in the goods side of the economy and the goods buying in the economy. So let's keep an eye on it, but I'm pretty encouraged.
Yeah, I'm going to pull up. I get this, subscribe to shadowstats.com, which is published by John Williams, economist. And since 1980 or thereabouts, he has been publishing white papers and research oriented to disclosing the actual rate of unemployment and the actual rate of inflation updated on a monthly basis. Okay, so think of this. Since 1980, so this is 44 years of data updated monthly. Okay, that's a lot of data. So, and he didn't know the future, but what he believed was that the government is not reporting correctly. They're underreporting inflation and underreporting unemployment, and by quite a bit. And every month he updates that data. So you can see the red line is what's called the CPI, Consumer Price Index, reported by the Bureau of Labor Statistics. And what he has tracked has been the actual, which is built back in the items that the government has taken out. So when those items are built back into it, and I won't go into the detail of what those are, but when you put in everything without any substitutions, you get the blue line. So what that is saying is, and this just came out, I got a copy of it, I think, yesterday. What that is saying is that the actual rate of inflation is about 12.5%, looking at the end of that blue line. At the end of the red line, I know what that number is. It is 4.1%. So between 4% and 12%, that's an 8% difference. That difference is what is being underreported by the government. So if you said inflation feels like it's going up at about 12%, then that's probably, you connect to the blue line. If you think inflation's going up 4%, okay, then you believe the red line. But anyway, that's the most current data updated through, this is actually through May of 2023. This is taken off of their website. Okay, now I'm going to shift gears. This is not about the economy, and this is mostly not about the stock market, but it caught my attention and I wanted to share it with you. You probably have seen this in the news, so I try to not report on politics and I try to not report on news that you probably have already seen. But this caught my attention because I'm from Seattle. I spent decades in Seattle. I went to the University of Washington. And so recently, this is on Friday or Saturday, there was a mishap with one of the Boeing 737 MAX jets. Now, Boeing is a Seattle company, or it was for many decades. And the saying used to be, as Boeing goes, so goes Seattle. Well, that changed many years ago, but Seattle was dominated by Boeing. But what happened, to play this clip, and this was another incident with the MAX jets where the side of the plane blew out. And it's reported by BBC News, which I thought did a really good job, and it's from the UK perspective. But the side of this plane blew out, and fortunately, at 16,000 feet, fortunately, no one was sucked out of the plane. That could have easily happened at 16,000 feet. And who knows what would have happened at 30,000 feet. But it turned out to be not too bad. But I'll play this, and then they give a really good background on the incident and on kind of the history of the MAX jets. I don't have anything negative to say about Boeing. I have high respect for Boeing. I want them to be successful. This is not a slight on Boeing at all, but just reporting something because it reminded me of so many periods of time in the past of Boeing's ups and downs in Seattle and Seattle's ups and downs that were affected by Boeing. So take a listen to this.
The U.S. airline regulator has ordered the grounding of more than 170 Boeing 737 MAX 9 passenger aircraft after a window and section of a fuselage blew out in midair during a flight. The Alaska Airlines plane had 177 people on board and was at 16,000 feet when it happened. The pilot made an emergency landing and no one on board was hurt. Here, the Civil Aviation Authority says safety inspections need to be carried out before the planes can enter UK airspace. Graham Satchell has this report.
Pictures taken by a passenger on board Flight 1282 not long after takeoff. Look closely and you can see a hole in the side of the plane. It looks like a window panel has been blown out. This is the pilot talking to air traffic control.
Yes, we are emergency. We are depressurized. We do need to return back to. We have 177 passengers.
More pictures, again taken by passengers, show the full extent of the damage in what was a terrifying experience for those on board.
All of a sudden I heard like a big bang and I didn't know exactly what was going on, but I look up and the oxygen masks were hanging from the ceiling. And then I look to my left and there's this huge chunk, part of the airplane just like missing.
There was a kid in that row who his shirt was sucked off him and out of the plane, and his mother was holding on to him to make sure he didn't go with it.
This is the latest incident involving Boeing's best-selling model launched back in 2015. In October 2018, a 737 MAX operated by Indonesian airline Lion Air crashed shortly after takeoff, killing all 189 on board. 5 months later, in March 2019, an Ethiopian airline 737 MAX was involved in a similar crash, killing all 157 passengers. That incident led to all Boeing 737 MAXs being grounded by the US regulator, the Federal Aviation Authority, for the next 20 months. After this latest incident, Alaska Airlines grounded all 65 of their 737 MAX 9 fleet for inspection, a quarter being given a clean bill of health tonight.
Part of this that reminded me of this history, so pardon the personal reference, but in 1971, I was young in 1971, but I remember this. So I've talked to people who were younger than I was. Almost everyone in Seattle remembers this. Down south of Seattle, toward Seattle-Tacoma International Airport, right in that area, right in the area where Seattle-Tacoma International Airport is, 2 real estate agents posted a sign, and if you go back far enough into Seattle, back in the 60s and 70s, and before, you know that there was a real estate company called Henry Broderick. And 2 agents from Henry Broderick scraped up enough money and bought a sign and posted it down by the airport saying, "Will the last person leaving Seattle turn out the lights?" And that was the feeling, because Boeing had gone from 100,000 workers down to, very quickly, down to 38,000. So that was a drop of 62,000 workers and their families and all the businesses that are affected by that. It was devastating for Seattle. I was trying to get my business started at that time. This was not a good time, but somehow I survived. But that was Seattle in 1971. So here we are today, and this is Seattle has expanded substantially. Boeing has expanded substantially. And so it is no longer, Seattle is no longer dependent on Boeing, and is no longer dependent on the airline industry. And Boeing is not even dependent on the airline industry as much, but it, you know, it does have an effect. So I just, a little bit of history, pardon the personal reference. And, you know, if you were in Seattle or know about it, you know about those times. And it's interesting that as I was thinking about this, I picked this cartoon saying to Janet Yellen, saying to the Bulls, "Remember a soft landing." And I was thinking of the MAX jet. Okay, so I think you understand. So thank you for watching, and if you have any questions or comments, leave them in the comment section below.